Hi everybody, it's Marcus Collins from MA Properties with your May Lexington market update. We've got 5 months worth of data in, so we can begin to make some predictions about what we anticipate the rest of 2022 is going to look like, and actually I think we have some insight too in terms of 2023. So stay tuned, we'll give you an in-depth look at what's happening with the Lexington market. Relatively easy to get information today, a lot in the press, much of it not very detailed, so it's much more difficult to take advantage of this to your advantage. And this is why we at MA Properties look very, very closely in terms of what's happening in the market. And as you'll see in a minute, we unpack a lot of different metrics, looking closely about what's happening. And that gives us an insight in terms of what you should do if you're thinking of buying and or thinking of selling. So, where can I find some of the information I'm going to show you this evening? Because there'll be lots of graphs and so on, and much of it is on our website. So if you go to maproperties.com, you will see many of the stats that I will show you this evening. We update them once a month. We do it for about 50 different towns. So even though I'm concentrating this evening on Lexington, if you have an interest, maybe you're living in Lexington looking to buy somewhere else, we have all of the information that you'll need. Just go to any one of the metrics that you will see and I'll talk about this evening, and you will see a drop down there and you can see it for about 50 different towns. So lots and lots of information on our website. You may well have seen this in the mail back in late January this year, the Lexington Market Review, where we looked at very closely what happened in 2021 and also gave our predictions for 2022. And if you want hyperlocal, what's happening in your area, we produce every year these trifolds, as we call them, which shows you the home sales within very specific geographical areas or neighborhoods in Lexington. So there's lots and lots of information. If you'd like any more information, just reach out to us. We can provide you with any of these, either electronically or as a paper copy too. So feel free to reach out to us if you'd like a little bit more information from anything I've just shown you. So let's take a look at what we're going to look at this evening. So we'll look at single family. I'll give you some analysis in terms of what we think is happening with the market, and then what's happening in the rest of 2022 and maybe even into 2023. So let's get started. Single family homes. First graph I always like to show is the inventory levels. Now what this is a snapshot of how many homes are available to buy on the first of the month. So every month I go out there, how many homes are available to buy, and we've been tracking this over a long period of time. The absolute numbers matter less than the overall trend, and that's true of many of the graphs I'm going to show you this evening, specifically true of inventory levels. So this is since 2006. You can see the high inventory levels there are because of the so-called downturn, the crash in the market, if you will. Inventory levels dropped in that 2013 timeframe as buyers came back into the market. And we've kept those relatively low inventory levels all the way through until 2019. Pre-COVID, there was much discussion around a recession, a downturn. Turns out that COVID overtook all of that, of course. And so we've seen lower inventory levels in 2020, lower again in 2021, and now we've got some insight into 2022. You can see even lower inventory levels then. Question arises, is this the fact that less people are listing their homes, or is it the buyer demand is high, or a combination of the two? So let's look at supply first of all. Supply. How many homes actually sell? This is the data for the last 10 years. And as you can see, declining until 2019, many sellers deciding to stay in their home, take advantage of high price appreciation in the town. And so the number of homes that sold, and actually the number of homes that listed, declined all the way through to 2019. Took a big jump in 2020, and that continued into 2021. COVID, many people thinking maybe now's a good time to take some profit, have prices perhaps as high as they're going to be, maybe not. Many people, their circumstances changed, and so they decided to move. And so we saw a large number of homes coming on the market and selling in both 2020 and 2021. Now, let's take a look at what's happening this year. In order to get an insight into that, we look at cumulative sales. So this is how many homes actually went under agreement, because I want to back out that 6 weeks between under agreement and selling. So this is cumulative sales, really cumulative under agreements. And as you can see, the blue graph there is 2021 and the orange color is 2022. We've got less homes selling and coming on the market, as it turns out, in 2022 than versus 2021. We're down about 50 homes. If we look at 2022 and compare it to 2019, the last year pre-COVID, you can see that they're about the same. So it looks like, as best we can see today, can't make an accurate prediction quite yet, we need a little bit more information, but it looks like today that we can anticipate the number of home sales to be consistent with what we saw in 2019. That's probably as best as we can say today, but as you can see, that's considerably less than we saw in 2020 and 2021. So a lot less homes coming on the market and therefore selling in 2022 in comparison to what we saw over the last couple of years, but beginning to get back to the kind of historic norms that we saw earlier in 2019 and 2018. So that's the supply side. Let's take a look at demand now and see what buyers' reaction to this is. Days on the market, pretty straightforward metric, how long a home stays on the market. The historical data declined quite considerably to about 28 days in 2021. Looking at the first 5 months, 2021 versus 2022, you can see a slight decrease, 36 days in 2021 versus 27 days in 2022. So it looks like we can anticipate a lower number of days, average days on the market in 2022 versus 2021. So again, strong buyer demand, driven by buyer demand, as well as less homes coming on the market, less listings. The other metric we always look at, the one we pay more attention to, honestly, and that is the sell price to list price ratio. So imagine a home comes on the market at 900,000 and sells for 900,000. That sell price to list price ratio is 100%. It's been around about 100% for the last decade or so, but took a dramatic increase from 100 to 106 in 2021. So very, very strong buyer demand. Remember 2021, number of listings was at an all-time high as well. So very strong buyer demand in 2021. Looking at, again, the first 5 months of 2021 versus 2022, we can see that ratio even higher. So first 5 months we're at 103% in 2021. The first 5 months of this year we're at 111. So it looks like we can anticipate an even stronger year in terms of this metric, in terms of buyer confidence, if you will, in 2022 versus what we saw in 2021. Driven, as I said, by buyer demand, buyer confidence, as well as less listings. So those two kind of doubling down, and therefore that ratio rising. We're often asked, well, that's great, but how does it change by price point? At what point are there essentially less buyers and therefore that ratio not reach those kind of 111%? And so what I'm showing here is the ratios by different price points. Under $1 million, 1 to 1.5, 1.5 to 2, 2 to 2.5, 2.5 to 3, and over 3. What you can see is that we're very strong up to about $2 million, and then it drops dramatically, perhaps not so, but certainly it drops from 112, that 1.5 to 2 to 102%, 2 to 2.5. Mirrors really what we saw in 2021, very similar, but in terms of where's that price point at which there are essentially less buyers, no surprise, it's at the higher price points, and it begins to have a material impact around about $2 million and above. Below $2 million, it's a very, very strong market. So that's what I'm trying to show with this, is to say that 2 million is and above, slightly weaker market, wrong word really, but it's not as strong as we see in the under $2 million price point. This is, I should say, this is list price, not the sale price. So what you're seeing at the bottom there in terms of those price ranges is that the price that a home is listed at, not that it finally sells at. So I want to kind of back that out of this data. So this is list price that I'm showing this broken down by. So that's strong buyer confidence, of course, and that leads in almost inevitably to higher prices. So let's take a look at that now. This is the average price for Lexington. As you can see, first 5 months of last year, around about 1.69 million was the average price, and we're currently at about 1.77, the running average for 2022. We're running at about 1.77 million. There's quite a skew of prices in Lexington in terms of more, in fact, coming on at the higher price points in 2021 than we saw previously. So to back out that skew, many people prefer to look at the median price. So this is the median sale price, slightly lower, but interestingly the same shape of curve in terms of how that median price is increasing. So 2021 was at 1.56, or 5 months of 2021 was at 1.56. The first 5 months this year, the running average this year at 1.64. That's about a 5% increase. We saw slightly higher rates of increase in 2020 to 2021, 8 to 10%, but 5% is kind of the norm, what we would ordinarily expect in the town. If you look historically since the downturn in 2005, 6, 7, 8, that time frame, since then we've seen on average around about a 5% increase. So we're returning after a bumper year, if you will, in 2021, returning to the normal numbers in terms of that price appreciation, running at about 5%. So that's kind of where we are. So what's driving today's market? What's happening to cause this situation we find ourselves in? So two major effects. First one, no surprise, I guess, it's that changing housing demands. It's still working its way through the system. If you look at towns like an Acton, which historically have not been that strong, predominantly because of the commute and the kind of trade-off that buyers make between commute, school, and what you can buy for your money. They tended to favor a lower commute, and therefore it's not been, for example, as strong as we've seen in the towns which are further in. That's changing, and in fact house prices in Acton, for example, but not just those kind of further out towns, Westford, Sudbury, Wayland, have seen a substantial increase over the last 18 months or so. And that's due to this kind of changing housing demands where buyers are reprioritizing, for example, commute versus what they want in a home. Maybe they need 2 offices because they're working from home 2, 3, 4 days a week, maybe 5 days a week. And so they're reprioritizing their requirements, prioritizing commute less than they did historically. And so that's one example of changing housing demands. As well as that, which is a COVID effect or pre-COVID effect, I guess, post-COVID effect, which will eventually work its way out of the system. There are some demographic shifts which are driving the market too. What you see here is from the last census we did in 2020. The number of people which are in each age bracket. Blue is male, red there is female. What's important is 2 areas where there are more people in these age brackets. The top yellow bar is the baby boomers, that is the children born after World War II. They are now working their way through their working career, now getting to retirement, and from a housing perspective, thinking about downsizing. So there's a group of buyers in the market looking to downsize, and those buyers, of course, are also sellers. So they're selling a more expensive home, buying a less expensive home in general. And so there's the downsizers that are kind of driving the market. The lower yellow bar are the first-time home buyers. They're moving out of rentals, maybe say Cambridge, Somerville, Boston, into their first home, and they're a big driver of the buy side predominantly. Clearly, they don't have a home to sell. So what we see, for example, if you pick a town like Arlington, very popular both with downsizers looking to move out of Winchester, Lexington, Belmont, for example, but also popular with first-time home buyers looking to move out of Cambridge, Somerville and Boston, but still wanting to be close to Boston. And so the sale price list price ratio we saw, for example, last year in Arlington was at an average of 109%. It was 106 here in Lexington. And so you can see that's having that impact on the market. And I have a little bit more to say about Arlington in just a moment. So this is the kind of baseline, if you will, driving the market. And then you layer on top of that the post-COVID effect of buyers changing demands. And that's kind of what's driving the market today, and why you see, for example, lots of buyers in the market looking for that change in requirements or looking for their first home. So that's kind of what's driving the market. That's the positive side. On the negative side, of course, we need to talk a little bit about interest rates. And what I show here is the historic interest rates, 30-year fixed and also the 5/1 ARM. And what you can see is, as we get in it seems like the last month, but 6 weeks or so, a very rapid increase in mortgage interest rates, with the expectation by the Fed that will dampen the market. As I say, the orange is 30-year fixed, the blue is 5/1 ARM. This is beginning to have an impact on buyers, although in this area anyway, in the area we're in, less impact than perhaps the authorities would like. One thing, one technique, if you will, buyers are looking at, of course, is instead of going for a 30-year fix, why not come for a 5/1 ARM or a 7/1 ARM, which will give them a lower rate. So kind of offsetting that high increase by shifting the product that they're looking at. So we've seen an increase in the number of mortgages which are ARM mortgages versus 30-year fix. But still, it is something that we really do need to look at. And if you look at the predictions, in reality, for what they're worth, they've not been particularly accurate. But today, anyway, the predictions are that these mortgage interest rates will last through 2022 and through 2023. These numbers are about the highest they've been for 10 years, just to put that in perspective. And we are beginning to hear stories of buyers having less money to spend. Time will tell whether that is actually the case, and I'll talk a little bit more about that when we talk about the predictions that we see for the rest of this year and next year. There's much discussion in the press around a housing correction or a housing bubble. So let's talk about this, because I'm always very cautious when I read nationwide statistics. I just happened to be flying into Houston a month ago now, and looking out of the window as I'm flying into that city, there was an awful lot of subdivisions being built. The road, the infrastructure was in place. It was just waiting for the houses to be built. And if you compare the situation there, where it's relatively easy to build houses, with the situation we find ourselves within inside 95, that's clearly a much different situation. You just can't build subdivisions inside 95. And so there's a kind of very stark difference between housing situation in a town where it's relatively easy to build houses, with where we are in Massachusetts, where it's much more difficult within 95 and to some extent within 495. So looking at the housing market at a nationwide level, we need to be very cautious. This is why I want to be very specific about what's happening in the local market, and that's why I look very closely in the last few slides in terms of what's happening to the market. But having said that, I think it's worthwhile looking at some information that we've got right now in terms of, is there some kind of correction on its way? So I wanted to juxtaposition, compare two towns. I want to compare Arlington, first of all. So I talked a little bit about Arlington previously, but as you can see with Arlington, the difference in the median sale price between 2021 and the running average in 2022 is over 20%, in fact 22%. That's a very high increase, and much, much higher than we've seen historically. We already saw a relatively large increase in 2020 versus 2021, but now a dramatic increase in the median sale price in 2022 comparison to 2021. And that we have to ask the question, is that sustainable? Compare that with what we're seeing here in Arlington, as I mentioned previously, around about 5%. That's much more in line with historical norms. And so it seems less likely that there's a correction coming within the Lexington market than there is, than there potentially is in the Arlington market, with a much higher increase in 2022. So I think we need to be very cautious about housing bubbles and corrections, although there are towns today that we need to look very closely at to make sure that we're not seeing a substantial and to some extent unsustainable house price increase, for example, here in Arlington, moving forward. And what will the impact of that be, in the rest of 22 with the rising interest rates, and then also, of course, into 2023. Interestingly, looking at number of home sales, it's at a high. It's similar to what we saw in 2021. So in terms of the number of home sales, they look to be about 12 months, for example, behind Lexington. So very high price appreciation and lots of homes coming on the market. So that's an interesting situation that we really do want to keep an eye on that to see if there isn't a correction coming in, for example, Arlington, although that does seem much less likely here in Lexington, where we're at kind of historical norms. So what about the future? What about the rest of this year and into 2023? So in terms of the number of sellers, that's decreased back to where we have normally been in 2019 and 2018. So we're seeing less sellers in the market today. The number of buyers in the market seems to be at the levels it's been previously, with those multiple offer situations occurring. So today anyway, we're seeing very much a seller's market. You still have to be very cautious around pricing, preparation, staging, marketing, and that clearly to get top dollars. There's no question about that. To get that very high sale price to list price ratio, buyers are still being very cautious about what they look at, cautious around pricing too. But we do today seem to be continue to be in a seller's market. Now, as for the rest of 2022, let's think about the impact of interest rates. Clearly, the intent of interest rates rises is to slow down the housing market. It's a little, given the how sharp those rates rose, it's a little early to have any kind of quantitative numbers in terms of what impact it's having on the market. So a little bit cautious on that. There's about a 6 to 8 week delay between a home going under agreement and selling. And so that time frame is literally at the time frame we've seen those mortgage interest rates rise. So in terms of those quantitative metrics, nothing quite yet. We need to see 1 to 2 months worth of data to be able to give you some clear guidance on that. Now, in terms of qualitative, what are we seeing? We are still seeing multiple offer situations. Just last weekend, we brought a home on the market, just over $2 million. We had multiple offers. We had actually 7 offers on that home. One of the agents in our team was successful in buying a home helping a buyer buy a home priced between 1 and 1.5 million. There were 9 offers on that home. So still we're in a competitive multiple offer situation. That's for sure. In terms of the impact of mortgage interest rates, we are seeing 1 or 2 appraisals coming in low. That's going to have an impact on buyers' ability to offer those higher prices. And to what extent is a buyer's ability to offer $1 million, $1.5 million, $2 million being impacted by mortgage interest rates? We are certainly seeing some pre-approvals being scaled back because of interest rates rising. They're unable to afford the monthly payments on that higher pre-approval amount. So we are beginning to see that scaled back. So in terms of those qualitative measures, there are some kind of dark clouds perhaps, maybe gray clouds anyway. We really do want 1 or 2 months more information to be able to put some hard metrics to that in terms of whether the interest rate rise are having a material impact here in the Lexington or in the greater Boston area, as they are expected to do, and as much of the kind of nationwide numbers begin to show. But today anyway, seller's market, lots of buyers are out, less than we have listings than we've seen previously. And then there's that kind of grey cloud, if you will, in terms of when will interest rates, if interest rates will have a material impact on the market. I want to see 1 or 2 months more data to be able to see if we can actually discern that having an impact here. As I say, based on how tight the market is here in terms of inventory levels in comparison to other parts of the United States, I anticipate less than we would see in other parts of the US. But let's see, let's get some real data to be kind of get an insight into that. So that is the May 2022 Lexington Market Update. Hope you enjoyed that. Lots of information here. As you can see, we love talking about this. We have lots and lots of information. So if you have any questions, please reach out to us. We'd love to kind of delve into not just the Lexington market, as I mentioned previously. We can delve into other markets too. And so with that, I'll say goodbye and hope we'll see you again with another market update next month. Bye.